The silver market just sent a warning signal that most investors will completely misunderstand. What happened was not random. It was not emotional panic. And it was definitely not the end of the silver story. It was something far more mechanical, far more dangerous, and far more revealing about the state of the global financial system. On Monday, December 29th, silver suffered one of the most violent intraday moves in modern market history. In just a few hours, price collapsed more than 10%, plunging from an intraday high near $83.71 all the way down to roughly $71. That kind of move doesn't happen in a healthy market. That kind of move only happens when something breaks. This was not a normal correction. This was not profit taking. This was not retail panic. This was a liquidation event. And to understand why silver crashed, you have to understand what was really being sold. Because it wasn't silver, it was leverage. The first thing most people miss is that silver didn't start this collapse. It was dragged into it. The real trigger came from the bond market and from gold. When bonds began to crack and gold suddenly dropped roughly $150, the pressure didn't stay contained. It spread. This is how modern markets work. Everything is connected through leverage. Large hedge funds and institutions don't trade assets in isolation. They borrow it cheaply and deploy capital across multiple markets at the same time. Bonds, equities, commodities, currencies, all linked through margin. When one leg of that structure starts to fail, the entire structure becomes unstable. And when margin desks start calling, funds don't sell what they want. They sell what they can. Silver is one of the most liquid assets on Earth. That makes it incredibly useful in a crisis, and incredibly vulnerable. So when losses appeared elsewhere, silver became the cash machine. Funds that were winning in silver were forced to sell those winning positions to cover losses in bonds and gold, not because silver was weak, but because it was liquid. This is the heart of every liquidity crisis. Assets don't fall because they're bad. They fall because they're sellable. Once that forced selling began, the market entered a dangerous feedback loop. As silver dropped, stop losses were triggered. Those stop losses turned into market sells. That selling pushed price lower, triggering more margin calls, which forced even more selling. This is what's known as a margin call cascade. It feeds on itself, and once it starts, it doesn't stop until the leverage is gone. What made this crash even more violent was timing. Holiday trading conditions meant thin volume. Many desks were understaffed. Liquidity was already low. In thin markets, price moves faster, much faster. It takes less capital to push price. And when large players see heavy leverage concentrated on one side of the trade, they know exactly what to do. They know where the stops are. They know where retail traders are positioned. They know where forced liquidations will trigger. And that's why this move had all the characteristics of a stop hunt. Key technical levels were sliced through with ease. Not because sellers suddenly believed silver was worthless, but because triggering stops clears the order book. Once those stops are hit, price doesn't fall gradually. It falls into empty space, a liquidity vacuum. And that's exactly what happened. But here's where the story changes and where most headlines get it completely wrong. While paper silver was crashing, physical silver didn't follow. Local coin shops did not slash prices. Online bullion dealers did not collapse premiums. In many cases, they simply refused to sell. The so-called spot price dropped $8. The street price barely moved. This is known as a physical disconnect, and it tells you everything you need to know. If silver were truly abundant, dealers would be desperate to sell. Premiums would collapse. Inventory would flood the market. That didn't happen. Instead, premiums stayed elevated. In some cases, they widened. Why? Because physical silver is not available in size. Dealers know how hard it is to restock. They know delivery times. They know wholesale supply constraints. They also know that paper price during a liquidation event is not real price discovery. It's a forced transaction. So they don't participate. They wait. This creates a split market. Paper collapses. Physical holds. And this exact phenomenon has happened before. In March of 2020, during the global liquidity panic, silver was obliterated. It fell harder and faster than almost anyone expected. The narrative at the time was that silver was finished. What happened next was one of the most powerful vertical rallies in silver's history. Liquidity crashes don't end bull markets. They reset them. They remove leverage. They clear weak hands. They clean the structure. And that brings us to timing. December is when funds reduce risk. They harvest tax losses. They rebalance portfolios. They delever. January is when new capital enters the system. Pension funds deploy fresh allocations. Institutional money resets mandates. Cash that was sidelined comes back into play. The seasonal pattern is known as the January effect. And it's not superstition. It's structural. By flushing the market in late December, the system clears itself just in time for new money to arrive. The weak hands are gone. The forced sellers are finished. The leverage has been purged. That doesn't guarantee an immediate rally. But it dramatically changes the risk profile. Now, the $70 level becomes critical. Not because it's magical, but because it represents exhaustion. If price stabilizes near this zone, it signals that liquidation pressure has ended. that sellers are no longer forced, that bids can begin to return. And remember, markets don't need buyers to rally, they only need sellers to stop. This is where psychology flips. Fear peaks near bottoms, not tops. And this brings us to mining stocks. Silver miners were absolutely crushed during this move. In many cases, they fell far more than the metal itself. That doesn't happen because miners suddenly became bad businesses. It happens because funds sell them indiscriminately to raise cash. Algorithms don't care about fundamentals. They care about correlations. So when silver falls violently, miners are dumped across the board. This creates something very specific: mispricing. Costs didn't change overnight, reserves didn't disappear, operations didn't break, but valuations collapsed. For smart money, this is exactly what they wait for. Liquidity events create value traps for emotional sellers and opportunity zones for patient capital. That doesn't mean miners immediately rebound. It means risk shifts. The same applies to silver itself. This crash formed a dramatic candle on the chart, a shooting star. It looks terrifying. It screams top. But in context, shooting stars often appear at turning points, not endings. Markets love to produce maximum pain before changing direction. They shake confidence, they destroy conviction, they force bad decisions. That's their job. The key question now isn't whether silver is volatile. It always has been. The question is whether the structural pressure that caused the crash is still active. If bonds stabilize, if gold finds footing, and if margin pressure eases, the reason for forced selling disappears. At that point, price action becomes about supply and demand again. And supply hasn't improved. Physical inventory is still tight. Industrial demand hasn't vanished. Monetary demand hasn't disappeared. What vanished was leverage. And leverage is always the first thing markets eliminate in a crisis. This is why experienced investors don't panic during crashes. They observe. They watch volume. They watch premiums. They watch behavior. Because behavior tells you more than price ever will. Right now, behavior says this was not distribution. It was liquidation. And liquidation is temporary by nature. Once it ends, the market enters a different phase. Not euphoric, not explosive immediately, but unstable in the opposite direction. Thin liquidity works both ways. Just as price can collapse into a vacuum, it can rise just as violently when sellers are gone. This is why V-shaped recoveries happen after liquidity events. Not because fundamentals suddenly improve, but because structure resets. The weak hands are out, the leverage is gone, and the market is lighter. That doesn't mean risk is gone, it never is. But it does mean the easy selling is finished. The next move will not be decided by fear. It will be decided by flows, by who shows up in January, by who steps in when others are still frozen. Markets punish certainty. They reward preparation. If this truly was a margin-driven liquidation, history suggests the rebound will come faster than most expect, and from levels that feel uncomfortable. That's how these events always work. They feel wrong at the bottom. They feel obvious only in hindsight. And the people who benefit are rarely the ones reacting to headlines. They're the ones who understand plumbing, liquidity, leverage, forced selling. Because when you understand those mechanics, crashes stop looking like chaos. They start looking like process. And process creates opportunity. Not for everyone, but for those who know what they're watching. Thanks for watching.